How to build a robust trading strategy. Trading success is often portrayed as this high adrenaline, split second decision making process. But here's what nobody tells you: 90% of profitable traders spend more time planning their trades than actually trading.
That's such a counterintuitive insight, especially when most people picture traders frantically yelling on the trading floor like in the movies.
And what's really fascinating is how trading styles break down into distinct categories, each with its own psychological profile. For instance, studies show that successful scalpers make an average of 10 to 15 trades per day, with holding times under 5 minutes.
Hmm, that sounds incredibly intense. How does someone maintain that level of focus while managing risk?
Well, here's the surprising part. Professional scalpers typically only trade during specific 2 to 3 hour windows when market volatility peaks. They're not actually glued to their screens all day, but rather laser focused during these high probability periods.
That makes so much more sense for someone trying to balance trading with other commitments. What about other trading approaches?
Let me break this down with some interesting statistics. Day traders typically hold positions for 2 to 4 hours and make 3 to 5 trades per day, while swing traders might only place 2 to 3 trades per week, but have a higher average profit per trade.
Those numbers really put things in perspective. I imagine the risk management approach varies significantly between these styles.
Exactly right. And here's where it gets really interesting. Professional day traders typically risk no more than 1% of their capital per trade, while swing traders might risk 2 to 3% because they have more time to manage their positions and use wider stops.
Tell me more about how traders actually choose which markets to focus on. There must be some systematic approach.
Research shows that successful traders typically master just 1 to 3 instruments in their first year. Think about it like this: if you're trading the EUR USD currency pair, you're really just tracking two major economies rather than trying to follow dozens of different stocks or commodities.
That certainly simplifies things. But what about the actual strategy development process?
Here's a fascinating statistic. A study of professional traders found that 70% use a combination of technical and fundamental analysis. Rather than strictly adhering to one approach, they're looking at both price patterns and economic indicators to make decisions.
So it's really about finding the right balance between different analytical tools rather than choosing just one approach?
Precisely. And what's particularly interesting is how this plays out in real trading. For example, technical traders who also incorporate fundamental analysis have been shown to have a 15% higher success rate than those who rely solely on technical indicators.
That's quite a significant difference. How do traders actually implement this combined approach?
Let me share a practical framework that's proven successful. You start with your fundamental analysis to determine the overall market direction, then use technical analysis to pinpoint specific entry and exit points. Studies show this approach can improve win rates by up to 25%.
Those numbers are compelling. What about risk management within this framework?
This is where the data gets really interesting. Successful traders typically maintain a risk reward ratio of at least 1 to 2, meaning they're looking to make twice as much on winning trades as they lose on losing ones. And here's the key: with this approach, you can be right only 40% of the time and still be profitable.
That really challenges the common assumption that good traders need to be right most of the time.
And that leads to another crucial insight. Psychological research shows that traders who focus on process rather than outcomes perform 30% better over time. It's about following your strategy consistently rather than trying to predict market moves.
How long does it typically take to develop this kind of systematic approach?
Studies of professional traders show that it takes an average of 18 to 24 months to develop consistent profitability. During this time, successful traders typically spend 60% of their time on education and practice, and only 40% on actual trading.
Those numbers really emphasize the importance of preparation and patience.
And here's what ties it all together: the most successful traders treat their trading like a business, with clear plans, risk management rules, and performance metrics. Research shows that traders who maintain detailed trading journals are 35% more likely to become consistently profitable.
Looking at everything we've discussed, It seems the key to success is really in the preparation and systematic approach rather than trying to make perfect predictions.
That's exactly right. And let me leave our listeners with this final insight. Studies show that traders who spend at least 3 hours planning for every hour of actual trading have a 68% higher success rate than those who don't. It's not about being right all the time. It's about having a well designed process and executing it consistently.
Risk management.
Trading is often called gambling with extra steps. But here's the shocking truth: 90% of failed traders didn't lose because of bad strategy. They lost because they completely misunderstood risk management.
That's such a powerful statistic. And it really highlights how people focus on the wrong aspects of trading success.
You know what I witnessed recently? A trader with an incredible 65% win rate who still blew up his account because he was risking 10% per trade. The math behind this is actually terrifying. Just 5 consecutive losses wiped out over 40% of his capital.
Hmm, that reminds me of something Warren Buffett once said about risk. It's not just about the odds of being right, it's about the consequences of being wrong.
Well, let's dive into why undercapitalization is the silent killer in trading. Most people jump in with tiny accounts like $500 or $1,000, thinking they'll turn it into millions through aggressive trading.
Oh my goodness. That's like trying to build a skyscraper with materials for a garden shed.
Exactly right. And here's where it gets really interesting. When you're trading with a small account and trying to grow it quickly, you're forced to take positions that are way too large relative to your capital. Let me break down the brutal math of recovery.
I have a feeling this is going to be eye opening for a lot of people.
So, check this out. If you lose 50% of your account, you need a 100% gain just to break even. But if you lose 75%, which can happen quickly with oversized positions, you need a 400% gain to get back to where you started.
That's exactly why the old trading wisdom about protecting your downside is so crucial.
Well, this brings us to the cornerstone of professional trading: proper position sizing. Most people think the 2% rule is gospel, but there's actually a lot more nuance to it.
How does that work with different trading styles? I imagine a day trader would need a different approach than someone making weekly trades.
That's such an important distinction. For day traders making multiple trades daily, even 2% is too aggressive. They typically stick to 0.5% to 1% per trade, while swing traders might go up to 3% since they're taking fewer positions.
You know what fascinates me about this? The psychological aspect of handling different position sizes.
Speaking of psychology, let's talk about something that really messes with traders' heads: consecutive losses. Even with a 60% win rate strategy, there's a 70% chance you'll hit 4 losses in a row at some point.
That must be why so many potentially profitable strategies fail in real trading. People just aren't prepared for those losing streaks.
Exactly. And it gets even more interesting with reward to risk ratios. A trader can actually be wrong 60% of the time and still be profitable if they're maintaining a proper 3-to-1 reward to risk ratio.
Well, that seems counterintuitive. Being wrong more often than right and still making money?
Let me break this down with real numbers. If you risk $100 per trade with a 3-to-1 ratio, winning 40% of the time means you make $300 on your winners and lose $100 on your losers. Over 100 trades, that's 40 winners at $300 each, $12,000, minus 60 losers at $100 each, $6,000, netting you $6,000.
So that's why successful traders focus more on their risk to reward ratios than their win rates.
But here's where most traders mess up: they start scaling out of positions too early. Taking partial profits might feel good psychologically, but it can seriously impact your long term profitability.
Like when people take half their position off at a 1-to-1 ratio, when they were originally aiming for 2-to-1.
Exactly that. Let's say you risk $200 for a potential $400 gain. If you close half at $200 profit and let the rest run to 400, you're actually only making 300 total instead of 400. That's a 1.5 to 1 ratio instead of 2 to 1.
You know, that really adds up over hundreds of trades.
Now, let's talk about something that hardly anyone considers: Unexpected risks. Things like internet outages, broker platform crashes, or sudden market gaps can devastate an unprepared trader.
Those black swan events can really catch people off guard.
Like during the Swiss franc debacle in 2015, traders who were overleveraged lost everything in literally minutes when the currency jumped 30% instantly. Some accounts went negative, owing more than their initial deposit.
That's precisely why having multiple layers of risk management is so crucial.
You know what's fascinating? The most successful traders I know spend more time planning for what could go wrong than dreaming about what could go right.
That really flips the common perception of trading on its head, doesn't it?
Well, here's the bottom line. Trading success isn't about finding the perfect entry points or having the most sophisticated strategy. It's about staying in the game long enough to let your edge play out.
So, in essence, it's not about how much you can make, but how much you can avoid losing.
Exactly that. The market will always be there tomorrow, but only if you have capital left to trade with. That's why risk management isn't just a part of trading, it is trading.
Developing a trading plan. Comprehensive guide.
Trading without a plan is like jumping out of a plane without a parachute. And yet, 90% of new traders do exactly that, losing an average of $5,000 in their first year alone.
You know what's really striking about that statistic? It shows how many people treat trading like gambling instead of treating it like the serious business it should be.
Let's dive into what makes a proper trading plan. Because here's something fascinating. Studies show that traders who follow a structured plan are 3 times more likely to be profitable in their first year compared to those who don't.
That's such an eye opening difference. I'm curious, though, what exactly makes a trading plan effective? Because clearly, not all plans are created equal.
Well, it starts with something that might seem obvious, but is often overlooked: understanding your true motivation for trading. Are you looking to replace your income, build wealth slowly, or maybe just develop new skills? Your answer fundamentally shapes everything else.
Hmm. That reminds me of the two different approaches we see with Carl and Monica. Their motivations led to completely different trading styles.
Exactly right. Let's break down Carl's approach because it's fascinating. He's working a 9 to 5 job and wants to use trading to fund his holidays. So he created this really intelligent system where he wakes up at 7 a.m., spends 30 to 60 minutes on market analysis, and then uses limit orders throughout the day.
The way he's adapted his strategy around his job constraints is pretty clever, using technology and notifications instead of trying to actively watch markets during work hours.
Then we have Monica's completely different but equally valid approach. She's chosen swing trading, focusing on daily candles and doing her main market review on Sunday evenings. What's particularly interesting is how she's matched her trading style to her lifestyle.
You know what's fascinating about both approaches? They've both found ways to make trading fit their lives rather than trying to reshape their entire lives around trading.
And that brings us to something crucial: time commitment. Research shows that successful traders spend an average of 20 hours per week on trading related activities. But that doesn't mean all 20 hours need to be active trading.
That's quite different from what most people imagine when they think about trading, isn't it? They picture someone glued to screens all day, making split second decisions.
Right. And speaking of misconceptions, let's talk about risk management. Studies show that professional traders typically risk no more than 1 to 2% of their capital per trade, while amateur traders often risk 5 to 10% or more.
The difference in those numbers is striking. It really shows how professionals think about preservation of capital versus amateurs who might be looking for quick gains.
How to create a trading idea.
Trading strategies are often compared to chess moves, but here's the thing. While 1,327 chess games end in a draw, the market never stays neutral. Today, we're exploring why having the right trading strategy can mean the difference between consistent profits and devastating losses.
That's such an interesting perspective. You know, I've always wondered why so many traders fail despite having access to the same tools and information.
Well, it really comes down to this fascinating interplay between personal psychology and market mechanics. Think about it. We've got data showing that around 90% of day traders lose money, yet the allure of quick profits keeps drawing people in.
Hmm, that's quite sobering. What's the first thing people typically get wrong when they start trading?
You know what's fascinating? Most beginners jump straight into complex strategies without understanding the basics of market sessions and time management, like trying to run before learning to walk, and the market has no patience for that.
Oh my goodness, yes. I remember talking to someone who tried day trading during their lunch breaks. They had no idea about market sessions or time zones.
That's exactly the kind of situation we need to prevent. Let's break down these trading time frames. You've got scalping, which requires constant attention, sometimes for just seconds or minutes. Then there's day trading, swing trading, and position trading, each demanding different levels of commitment.
Well, that brings up an interesting point about lifestyle compatibility. How do people match their trading style to their daily schedule?
This is crucial. And here's why. If you're working a full-time job, attempting to scalp during your coffee breaks is like, well, it's like trying to perform surgery while riding a bicycle. You need to align your trading approach with your available time and attention span.
The surgery analogy is perfect because both require complete focus and preparation.
Exactly right. And speaking of preparation, let's talk about market sessions. The global Forex market, for instance, has this fascinating rhythm, like a relay race passing between Asia, London, and New York.
Oh, tell me more about these sessions. How do they affect trading opportunities?
Well, here's something most people don't realize. During the London New York overlap, which happens from 8 a.m. to 12 p.m. Eastern Time, we see about 70% of the day's total trading volume. That's when the biggest moves typically happen.
That's incredible. No wonder so many traders focus on those specific hours.
And this brings us to another critical point, choosing the right instruments. There's this misconception that you need to trade everything to be successful. But the data shows that specialists who focus on one or two instruments often outperform generalists.
So it's better to be a master of one than a jack of all trades?
Precisely. And here's why. Each instrument has its own personality. Take Forex pairs. EUR/USD behaves completely differently from exotic pairs. It's like learning a language. Better to be fluent in one than barely conversational in 10.
That makes so much sense. What about these different types of trading strategies we keep hearing about?
Now we're getting to the meat of it. There are four main categories: trend following with breakout, trend following with holding levels, range bound breakout, and range bound holding levels. Each requires a different mindset and approach.
You know what's fascinating about that? How these strategies can work in completely opposite market conditions.
Exactly. And here's the kicker: successful traders don't just pick a strategy at random. They analyze their personality type, risk tolerance, and available time before choosing their approach. It's like dating. You need to find the right match.
How to backtest trading strategies.
You know what blows my mind? Professional traders have this almost supernatural confidence in their strategies. And today we're going to unpack how they build that through something called backtesting. It's like having a financial time machine.
That's fascinating. How exactly do they develop that level of confidence without being able to see the future?
Well, it's all about using historical data as a testing ground. Think of it like a scientist running experiments. You're looking at how your strategy would have performed across thousands of different market scenarios.
So tell me more about these testing methods. I imagine there must be different approaches.
There are actually two main paths traders take: algorithmic testing, which is like having a supercomputer run through millions of scenarios in minutes, and manual testing, which is more hands on but can take hundreds of hours to complete.
Hmm. Why would anyone choose the manual route if it takes so much longer?
Here's what's fascinating: manual testing helps develop what traders call market intuition. You're not just crunching numbers, you're training your brain to recognize patterns and understand market psychology on a deeper level.
That makes sense. Like how a chef needs to actually cook dishes rather than just read recipes to develop their culinary instincts.
Exactly. And just like cooking, there are crucial variables to consider. One of the most important is the relationship between risk to reward ratios and win rates. Some strategies might win 70% of the time with small profits, while others might win only 30%, but make huge gains when they do.
That's really interesting. How do traders measure which approach is actually more profitable?
This is where the science comes in. We use something called the Sharpe ratio, which measures return versus risk. A Sharpe ratio above 1 is considered good, above 2 is excellent. Then there's the profit factor, which shows how much money you make compared to losses.
These sound like complex calculations. How do traders keep track of all this data?
Most use detailed spreadsheets, tracking everything from entry prices to emotional states during trades. Some even use Monte Carlo analysis, which is like a weather simulator for trading. It runs thousands of possible scenarios to stress test your strategy.
That's quite sophisticated. How many trades do you need to test before you can trust the results?
You need at least 100 to 200 trades for statistical significance. It's like conducting a scientific study. 10 trades might be luck, but 200 trades across different market conditions? Now you're looking at meaningful data.
So, what happens when market conditions change? How do you account for that?
That's where out of sample testing comes in. You test your strategy on completely different time periods than what you used to develop it. If it worked well in both 2018 and 2023, that's a good sign of robustness.
What about the psychological aspect? That must play a huge role.
Oh, absolutely. The maximum drawdown metric is crucial here. It shows the worst losing streak you might face. If you know your strategy historically had a 25% drawdown, you need to honestly ask yourself if you can handle losing a quarter of your account before things turn around.
That's quite a reality check. How do successful traders deal with those emotional challenges?
They prepare extensively through paper trading, practicing with virtual money after backtesting but before using real funds. It's like a dress rehearsal that helps build both confidence and emotional resilience.
This whole process seems much more scientific than most people would expect.
That's exactly right. Successful trading isn't about hunches or hot tips. It's about having a systematic approach based on proven principles. Think of it like being a researcher who develops a hypothesis, tests it rigorously, and only then puts it into practice.
You've completely changed my perspective on trading. It's clearly more about preparation than quick decisions.
And that's the key insight. Professional traders spend far more time testing and preparing than actually trading. It's like an iceberg. The trading you see is just the tip, but underneath is this massive foundation of analysis and preparation.
What would you say is the most important takeaway for someone interested in developing their own trading strategy?
Start simple and focus on thorough testing. It's better to have a straightforward strategy that works consistently than a complex one that looks great in backtests but falls apart in real trading. Remember, even the most sophisticated trading systems started with basic principles and rigorous testing.
Forward. Testing of trading strategies.
Trading strategies are like parachutes. You better test them before jumping out of the plane. Today, we're exploring why 90% of traders crash and burn by skipping one critical step: forward testing.
That's such a powerful analogy. And it really highlights why paper trading isn't just some optional step. It's literally your safety net.
Let me share something that blew my mind when I first learned it. Studies show that traders who spend at least 3 months forward testing are 70% more likely to be profitable in their first year of live trading.
That's a fascinating statistic. Though I imagine it's hard for most people to be that patient when they're eager to start making real money.
Exactly right. And that's where the psychology comes in. You know what's interesting? Even with paper trading, research shows traders experience about 40% of the emotional response they'd have with real money.
Speaking of emotional responses, can you break down the main elements that forward testing helps us discover? Things we might miss in back testing?
Oh man, there are so many hidden gotchas that only show up in forward testing. First, you've got unfilled orders. Imagine placing what looks like a perfect trade, but the market moves so fast your order never executes.
That must be incredibly frustrating when it happens with real money. What about slippage? I've heard that can be a real profit killer.
Let me tell you about slippage. I was working with a trader who lost $5,000 in one trade because he didn't account for it in his testing. The difference between his expected entry price and what he actually got was devastating.
Oh, wow. That's a painful lesson. And then there are all those sneaky fees that add up: spreads, commissions, overnight swap rates.
Speaking of fees, here's something most traders don't realize. In some currency pairs, swap fees can eat up to 30% of your potential profits if you're holding positions overnight.
That's incredible. No wonder so many new traders get blindsided by these costs. How do you recommend someone actually get started with forward testing?
Well, first, you need what I call the trading trinity: a detailed playbook, a comprehensive trading journal, and a thoroughly back-tested plan. Let me tell you about a trader I know who skipped the journal part.
Oh no, I can already tell this isn't going to end well.
He thought he could keep track of everything in his head. 3 months later, he couldn't figure out why his strategy wasn't working. Turns out, he'd been slowly deviating from his original rules without even realizing it.
That really shows why documentation is so crucial. And I imagine having a parallel journal for missed trades is equally important.
Absolutely crucial. And here's why. Studies show that traders who track missed opportunities identify up to 40% more profitable setups over time. It's like having a second set of eyes on the market.
That's fascinating. Let's talk platforms. I know MetaTrader dominates the space, but what about some of the alternatives?
Well, here's something interesting. While about 85% of retail traders use MetaTrader, data shows that C-Trader users actually have a slightly higher success rate, around 3% better on average.
Really? What do you think accounts for that difference?
The cleaner interface and better risk management tools make a huge difference. But here's the key. Whatever platform you choose, you need to set it up exactly like you'll trade live.
You mean down to the same starting capital and position sizes?
Precisely. And this is where most people mess up. They'll paper trade with a $100,000 account when they only plan to start with $5,000 live. The psychology is completely different.
That makes so much sense. How long do you typically recommend someone forward test before going live?
Here's the data-driven approach. You want to see at least 20 trades, but ideally closer to 100, across different market conditions. And get this, traders who test through at least one major market event have a 60% higher success rate in their first year.
That's really compelling evidence for taking your time with testing. What about the transition to live trading?
This is crucial. Start with a small account, like $200 to $500. Studies show traders who scale up gradually have a 45% higher chance of long-term success compared to those who jump in with larger amounts.
And I imagine that's where prop trading firms like FTMO come in?
Exactly right. They've actually revolutionized the transition process. Their data shows that traders who pass their challenge have a 65% higher success rate in live trading compared to those who go straight to personal accounts.
Those are some powerful statistics. What final advice would you give someone just starting their forward testing journey?
Here's what the data tells us. Traders who maintain strict discipline in forward testing for at least 8 weeks have a 73% higher chance of success when they go live. It's like building muscle memory for your trading brain.
That really puts it in perspective. This isn't just about testing a strategy, it's about developing the right habits and mindset.
And that's the key takeaway. Forward testing isn't just about validating your strategy, it's about validating yourself as a trader. The numbers don't lie. It's the bridge between theory and profitable reality.